Welcome, everyone, to this episode of Bondcast, the podcast series where we discuss the biggest themes and events shaping rates markets. I'm John Briggs. I'll be guest hosting with Imogen on holiday this week, and I'm joined by Jan Nevruzi and Giles Gale. Right into it, we're in this week of a period where we don't have any central bank meetings, but it's in between the ECB from last week and then the Fed and Bank of England, as well as several Scandi central bank meetings next week. So that gives us the opportunity to talk a little bit about both. We're going to start actually by looking ahead with Jan Nevruzi with regard to the Fed meeting coming up. So, John, we've got several things to kind of go over here: tapering, dots, overall messaging, tone. Give me the potpourri. Go where you want with this, and what do you think is the most important stuff, and what do you think our views are different, perhaps, than consensus?
Right. So, like you said, while this meeting is not as much of a risk event as it could have been like a month ago before the previous jobs numbers. But we are looking at a few updates that could kind of surprise the market, perhaps. The first, starting with the FOMC statement, two key things there. The first, there's probably going to be some acknowledgement that activity and employment have moderated down, just a little bit of a dovish refinement there. I think that's kind of hard to, they have to tame down expectations a little bit, mark the market, excuse me. And the second, of course, now we're getting towards the end of the year. We expect to see an update on the language around taper a little bit, and possibly even include a statement that says the taper will start this year, as opposed to at some of the future meetings. Additionally, and I can get into taper in a little bit, but just to kind of go over our base expectations for the FOMC meeting. Additionally, it is a close call, but since it's one of the quarterly meetings, we're going to get the updated dot plot and the economic projections. That could be something that sort of catches the market a little bit off guard too, if there's a big surprise there. We do not expect the dot plot to signal any hikes in 2022. It is a very close call, but we think it will be maintained at the same level for now. However, for the 2023 dot plot, we expect to see a slight revision to show for the median to increase a little bit. And just a reminder, at the June meeting, it was 7 out of the 18 participants who had penciled in at least one hike for next year. So it take only 2 officials to lift the median for next year to show a hike. So it's really not that much, but like I said, it's a close call, but we do think that it's not going to tip over into that. Similarly, for 2023, it was 13 out of the 18 officials that had at least one rate hike in 2023. So if one more forecasts a hike in 2023, the median will lift up again. And of course, finally, the economic projections should show, like I mentioned, a relatively lower GDP expectations and higher inflation expectations for 2021, which kind of the inflation part reverses a little bit next year. And really, officials have to increase their inflation forecast this year in order to maintain sort of like credibility, given how much we've run up in inflation. In fact, when I was discussing with our economist, Kevin Cummings, he was saying, at this point, if they don't update them up, if they don't revise their inflation expectations, we basically have to have deflation for the remainder of the year for them to, kind of match reality. And for GDP, of course, they have to reflect the slowdown in activity. So those are the key things we're looking at.
Okay, so it sounds like our views of, a November announcement for December start are still on track then?
Yeah, I think so.
Okay.
Yeah, go ahead. Sorry.
No, I was just saying, I know you've done actually some analysis in combining that with our expectations that the treasuries could start reducing supply starting in November. How do those two net out if we look forward kind of from let's assume that we're right on both fronts, and going forward into 22, how does that, is there more reductions? Is there more reductions in the Fed pace, or does that change the supply and demand balance?
So of course, there's a couple of caveats there. While it won't be as straightforward, coincidentally, it just happens so that our forecast is for altogether so just as like a background, we expect from the November refunding, treasurers to start cutting coupon issuance just because they ramped up so much, and now this current base is overfunding them so much. Just so coincidentally happens that our forecast for the entire drop in treasury coupon supply for starting from November and into next year is about $1 trillion. which happens to be exactly how much, not exactly, but very close to the 960 billion or so that the Fed absorbs in treasuries each year with the current 80 billion a month purchase space. So those, like on a higher level picture, they would net out, which of course they wouldn't, because the composition and treasury issues brand new securities that are much more liquid, and the Fed buys off the runs from the secondary market, providing the greatest amount of liquidity for them. So those won't offset each other, and you could have some more technical complications. But on a amount left for the public, yes, I think they pretty much, if we are right, will end up offsetting each other.
Not coincidental, I would say. All right. Thanks for that, John.
Yeah.
We'll see how that turns out next week. We'll check in after. I'm going to turn now to Giles Gale. Giles, so Europe, any follow-ups that, the views on the ECB? We did cover that last week, but just want to see if there's anything new on that front. And related to the ECB was, that we saw some revisions upward in growth and inflation, but not as much as we thought they could. Yet the market has seen ongoing increases in market inflation. Like you look at Euro, 5-year, we've basically been grinding higher all year. So what are your thoughts on that? And then I'm going to throw in, another wrinkle, which is why haven't nominals moved quite as much with, especially in the long end in Europe, with this grind higher in inflation expectations?
Okay, so quite a few things there. I mean, I suppose that from the ECB, not that much new in terms of what the way that we think about them. There was there was a Schnabel speech this week, which spent a lot of time discussing their view of rates, which I thought was quite interesting. And I've been telling everyone to at least have a look at the slides from that speech, because there's some quite interesting stuff in there. And essentially what she's saying, which isn't going to surprise any sort of market specialist, I suppose, is that break-evens, as in break-even inflation, market-based inflation expectations can rise quite a lot compared to what they might have been able to do in the past, without that necessarily implying a higher path for interest rates, simply because they've been so successful. And this is all about them patting themselves on the back, I suppose. They've been so successful, maybe just in the last 6 months or so, at sort of fighting back against this expectation that they operate on some kind of Taylor rule type reaction function. So there, I mean, if you've been listening to the ECB recently, even if not paying all that much attention, there wasn't all that much, I think, that you would be particularly surprised by. The other thing that she was saying, though, this is a little bit tangential from your question, John, but regardless, I think it was important. The other thing that she was saying was that, in their assessment, just macro uncertainty, and particularly sort of related to COVID, has been depressing yields quite a bit. So there, and there, it seems like the assumption is that will dissipate over the coming months. At least that's it's a pretty strong base case. And I think that's an important thing just to bear in mind, that they are taking this slightly more permissive stance with regard to longer term market rates, in the expectation that the pressure will be upwards in rates. And so that, I think, is an interesting little shift, if you like. So if the basic question is anything new to think about the ECB, no, but a bit of an evolution on that front there. There was also a whole load of stuff about how much of an impact that what they're doing is having on rates. How much does QE? How much are they squeezing the market? What's the free float in bonds outstanding, and so on. And I think it's always interesting to hear, given that they are the ones that are really the biggest player in the market, and they're the ones at times are viewed as squeezing rates. It's interesting just to hear from them the way that they view it. So that was really the discussion this week. On inflation, listen, I mean, inflation all of a sudden is interesting in Europe, and I mean, this is something that's been coming for a while. I mean, we've had a pretty much one direction rally all year in long-term sort of in inflation break-even. So, we've been talking about 1.85 as a kind of long-term sort of year-end-ish kind of target for the five-year measure of inflation expectations. And, we have actually, I mean, from that looking surprising, potentially ridiculous at the beginning of the year. I mean, we're within striking distance now. But what's more, the curve is actually inverted. So all this stuff about supply constraints and labor markets, I mean, I know how tight are those, and are there skills mismatches, and is immigration a problem, and all these kinds of things. They all really seem to be urgent at the moment. And I think that this question of how transitional inflation is going to be, even in Europe, okay, maybe it is, maybe it does wash out, but it's not washing out nearly as quickly as people thought. And I think that is starting to change the way that people think about rates overall. But something I've repeated again and again. We came into this year with there's a low inflation trap kind of mindset, which really sort of sets the tone for euro nominal rates. And I think that is being eroded at the moment.
Okay, so on euro nominal rates, so we've seen bunds go from -50 when you went to the sidelines over the summer, realizing the technicals. Now we're at -30. What do you see between here and year end? And you mentioned a little bit about how the ECB, taking out bonds and how they're looking at it. Side note, I always think it's fascinating how the Fed says inflation expectations look anchored, but then they buy most of the public supply of it, of tips. But how does the new supply demand dynamic impact your view? Does it not? Is it only on the marginal side? Basically, where do you see 10-year bonds going to the end of the year?
Right. I mean, I still see higher yields. I don't think I'm alone in that. But I think it's still perfectly reasonable to project a move towards, say, zero for 10-year bonds. And just on the supply side, I mean, we did a whole load of work last week on this basic question of how much of supply is coming onto the market and how much is the ECB sucking back out again, and how much is left for everyone else. It seems like, roughly speaking, there are compositional things, so there's credit and surplus and government and deficit, but overall it looks like we've got, we're roughly in balance, and we have actually been for most of the year. I mean, I suppose that given that we sold off a lot in the first part of the year, then we squeezed, and how does that really leave us? I think it leaves us okay to engage with fundamentals between now and the end of the year. And I think that as people think about recovery for next year, and the conversation we'll have to have in a couple of weeks' time when European governments start submitting their draft budgets for 2022, will be, what does the supply picture look like on a perspective, not just to the end of the year, but for the whole of the rest of next year. And there, I think we will be talking again in terms of a fairly bearish environment, and people, I think, will want to engage with that.
All right. Well, that's it for this week. Thank you for joining this episode of Bondcast. Next week, we look forward to doing some recap on these major central bank meetings and how they're going to impact our views going forward. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find. Thank you very much.